makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in for Francine Lacqua in London. Now, Federal Reserve Governor Lisa Cook says she will not be bullied into stepping down from the central bank. This after President Trump called for her resignation over allegations of mortgage fraud. Federal Housing Finance Agency Director Bill Pulte says Trump has cause to fire Cook.
She lied, in my view, in her statement tonight because she said that the first time she heard about it was through my tweet. She didn't hear about it from my tweet. There's no way. She doesn't follow me on Twitter. I think this lady is a professional liar. She shouldn't be at the Federal Reserve. She's going to resign, in my view. And if she doesn't resign, I do believe that the president has cause to fire her. And that will be up to the president whether he decides to do that or not.
Important to note, of course, that no charges have been filed against Lisa Cook. Let's bring in Bloomberg's chief Asia correspondent, Ros Mattson, now for the details on a Lisa Cook who is now in the firing line of this Trump administration. What is being alleged? How has she responded? How significant is this potentially?
Well, it is significant because it's the latest salvo by this administration against the Fed, chipping away at the Fed over time. Obviously, Jerome Powell, but now also Lisa Cook, and it's the White House, but it's also the Federal Housing Finance Agency, which is coming heavily for her, as you just heard. And the accusation seems to be that she was essentially juggling mortgages for primary residences. So you've got more than one on the go around the same time. They're overlapping. And it's not a completely uncommon practice, but obviously it's very much into a grey area. And that's the accusation that's been levelled against her. Obviously, she's denied this and says she stands ready to defend herself. But it's interesting because there's also the accusation that the administration has levelled at some other people who they're having disagreements with. So some politicians, including, leaders in certain states, they put these allegations against other people too, saying you're accused of mortgage fraud. So it's not something that's completely out of the playbook for this administration. I mean, she's obviously come out again and said very strongly that she's going to defend herself. But the overarching message here is that this is an administration that's not going to stop coming for the Fed either way. This is an administration that wants to rework and rebuild the Federal Reserve. So how should we be thinking about this accusation in that context? Well, that's right. So obviously, if they can loosen up another vacancy on the Fed, that enables this administration to rebuild the Fed in their own image, in a way, perhaps with some more like-minded individuals. And they've got quite a few balls in the air on that already. I mean, you've got the point where Jerome Powell's term will end. They've kind of stopped the idea of firing him or the possibility of trying to do so, but they're not stopping criticising him either way. And we've got, of course, the temporary replacement at the moment for Adriana Kugler, Stephen Moran, who's in until January, and that gives them time to map out who they would put in properly for that vacancy potentially. And there's a lot of names in the air from within the administration, but also within the Fed itself, and perhaps some Fed officials who they see as more conducive to Donald Trump's thinking, especially on interest rates. But what it could do is enable them to build the Fed into something that they want to some extent. That raises further questions about the independence of the Federal Reserve. And you see that in institutions across America. It's not just the central bank, but it's looking at courts and other important parts of the machinery for the US, and are they, looking to put in people who would be more conducive to their own thinking? OK, Ros Mattson, thank you very much indeed. Overseeing our coverage, of course, out of Asia here in London for today, at least with that context. Ros, thank you. Meanwhile, US megacaps dragging down the Nasdaq despite a bounce off session lows. We did see a bit of dip buying towards the end of the session yesterday, it seems. Markets are in something of a wait-and-see mode ahead of the Federal Reserve's Jackson Hole meeting. Joining me now is Karen Ward, EMEA Chief Market Strategist at JPMorgan Asset Management. Karen, good morning. Thank you for joining us. Is J Powell the next catalyst for these markets?
Quite possibly. I mean, I think the market is expecting J Powell to do a continual good job, as he has been doing, of getting the balance right, of making absolutely clear that what's going on in the background is noise. They are an independent central bank. They will set policy according to what's happening in the policy in the economy. But he's in his safe space. He's got his fellow central bankers around him. And the topic of the conference is the labour market. And I think really laying out that, yes, demand is weakening for labour in the US economy, But there's an awful lot also that's happening on the supply side because of migration, and therefore the outlook for inflation and second round pressures, should we get a bump in headline inflation, which seems very likely after the tariffs, I think that would get markets pretty concerned about the current pricing, because that's the part of markets at the moment that concerns me. There's a lot of rate cuts for the Fed price. We've still got over 100 basis points in the coming year. That doesn't sit with how I see the outlook for the US economy.
The market pricing, the markets are over their skis in terms of price. Are they over their skis in terms of pricing September?
I think quite possibly. I mean, all it's going to take is a bit of stickiness in inflation and actually a labour market print which shows it's not falling off a cliff for the market to say, hang on, maybe actually this isn't going to be a particularly preemptive Fed. And for markets, that's what's really important. Markets love preemptive central banks, not reactive central banks, because, of course, when they're then reactive, usually downturns have already gathered momentum. So, yeah, I think it could be a really important meeting.
Do you worry about Fed independence?
Yeah, I mean, I was sitting listening to Rosalind speaking just then, and all that was going through the back of my mind was dollar, dollar, dollar. You know, everything we're talking about here, all of these checks and balances on the US system is all what underpins its reserve currency status. Everything that underpins why global investors have for the last 20 years wanted to park their money in US assets. And the Federal Reserve is absolutely central to that. So picking away at global investors' perceptions of whether the Fed can safeguard, preserve that value of the dollar, you know, we have to be very mindful of that. So I think as investors, even if what transpires over the next few years ends up in a Federal Reserve more willing to cut short rates, what we need to be thinking about is what's happening to the long end and what's happening to the dollar. Because particularly as outside of the US investing, that's where any perception that this is not appropriate policy is going to show up.
And as you were thinking about the dollar, I was thinking about Hungary, I was thinking about Turkey, I was thinking about how those institutions were remoulded in the likes of Erdogan and Orban over in Hungary. When we think about how that ties in then to the rotation trade out of US equities into Europe, that had been such a front and centre trade earlier in the year. It seems to have faded on the back of strong earnings out of the US, particularly with tech.
Yep.
Does that come? Where are we in that story?
I still think we're at the beginning. I mean, if I look at valuations, to me it still suggests that, you know, there's still a lot of pessimism about Europe generally. Although the valuation discount has closed slightly, it's still beyond what's normal. And so I think that relative optimism about the US, pessimism about the Europe is still there. So when I think about how we then move forward, it's coming from both sides, from my perspective. In the US, tech is an important component of the story. I'm still a little bit nervous that we haven't really gone through the real tech test yet. You know, these companies are investing massively in these new technologies, but the question is, how much are they going to be in demand and at what price in the broader economy? It's quite rare historically to see a capex downturn because of uncertainty and tech earnings not decline. So I'm a little bit, there's a few risks around that. And then on the Europe story, you know, we've just seen the composite PMI this morning. I think we're just at the beginning of Europe's recovery. We haven't yet seen the German fiscal money hit the economy yet. The consumer's just waking up to lower interest rates. They've got all those savings that they can go out and spend. So I think the growth differential is going to look increasingly appealing. And, you know, after a decade of Europe underperforming, there's still a lot of scepticism and there's still a lot of money to move.
How do you explain then, you've touched on this partly, but in terms of the moves that we've seen into equities in Europe and what's really driven the growth in the upside that we've seen year to date has been value stocks and small caps, and in the US it's been growth.
Yeah.
Is this a hedge by investors? Is it two different groups of investors? How do we make sense of that kind of split view on the stock story regionally?
Well, I think in Europe, so as you say, value and small cap. The small cap is interest rates have come down. We know small cap is pretty interest rate sensitive. Interest rates have halved in Europe. That small cap space is responding. And Europe's small cap is often an exciting area of the market. So that's been revitalized, and value is all part of just this reassessment that maybe Europe isn't stuck in the rut that it's been in the last decade. Maybe actually this confrontation from Russia and from Trump is actually galvanizing the region into some good policy, and maybe we're discounting some of those sectors too heavily. And then, tech, as I've already explained, on the US side, we're going to see. I'm not pessimistic on tech. I just think there's a very high expectations on quite how easy the transition from investing to selling the product's going to be. And usually, historically, it's never a straight line.
Yeah, MIT coming out with a survey and some data suggesting that the ROI is still a piece that is missing in terms of investments around AI and adoption by around businesses and by businesses. The FTSE 100, a fresh record yesterday, and part of that seems to be because the FTSE 100 doesn't have a lot of exposure to chips or to AI. Is there further to run, do you think, for UK big cap stocks and the FTSE 100, or is it looking a little stretched at this point?
Well, we know that the UK benchmark is heavily weighted towards energy and mining. So energy, partly because of political factors, but actually partly just the AI story itself. We know these technologies are incredibly energy hungry. That's underpinning energy prices. We've seen that uplift. So the FTSE tends to go with it. I mean, it's one of the things we've said is that when you're thinking about hedging yourselves from some commodity risk or from some inflation risk, actually the UK benchmark is a pretty good place to be. I mean, if you go back to 2022, when most markets were down because they were worried about inflation, the UK benchmark was one of them that was up. So I think it's part of that inflation narrative where actually the UK market will give you a bit of resilience.
OK, Karen Ward, thank you very much indeed. JPMorgan Asset Management EMEA Chief Market Strategist. Investors should be readying portfolios to that point for inflation surprises, and the rotation from US to European equities has further to run. Coming up, Russia demands a role in the security plan for Ukraine and says China needs to be involved too. Details are next. This is Bloomberg. The conversations matter, the insights you need. This is The Pulse. I'm Tom Mackenzie in London. So, US Vice President JD Vance says negotiations over ending Russia's war in Ukraine are focused on security guarantees for Ukraine and territory that Russia wants to control. Speaking to Fox News, Vance added that this would include Ukrainian territory that Russia is not, at this point, occupying.
And we've made a lot of progress, Laura. Look, who knows what's going to happen? The president tells me this all the time. You can never say with certainty what the outcome in this situation is going to be. But we now have the Russians talking to the Ukrainians. They're talking details about what would be necessary on each side to stop the fighting and stop the killing. We've made more progress in 3 months than the country had made in 3 years in stopping this conflict. And I think it's because sometimes you just need a president who will pick up the phone and call somebody.
Well, for more, Tony Halpin, who leads our Russia economy and government coverage, joins me. Tony, what sort of guarantees, in terms of security guarantees, are being considered for Ukraine and potentially Russia's own involvement in those security guarantees?
Yeah, so Vice President Vance's comments there just illustrate some of the difficulties because while he mentioned it in terms of security guarantees and territory, for Ukraine, some of the territory that Russia wants is critical to their defense. So it's not as simple as two separate issues. Russia is also clouding the horizon somewhat by talking about the need to be involved in any security arrangements for Ukraine and also potentially involving China as one of the United Nations permanent 5 powers. European powers on top of that are also trying to forge some kind of NATO-light agreement that would set out what kind of security defense provision they would make in the event that Ukraine gets attacked in the future. So there's a very complicated picture, lots of moving parts.
Tony, it's quite remarkable on some levels to consider that Russia is suggesting that it has a role in a security guarantee which would involve securing Ukraine against, ultimately, Russian aggression. Is what we've been hearing from the Russian foreign minister, Sergei Lavrov, is this an attempt by Russia to pour cold water on the modest optimism that has come out since this meeting in the White House?
Yes, in some ways it is. It's just to underline the difficulty, really, of trying to come to a solution to this war. But it's also part of how Russia views the conflict. In many ways, they don't view it simply as a confrontation with Ukraine, a conflict and a war with Ukraine. Putin has always viewed it in many ways as a confrontation between Russia and the West, which is taking place in Ukraine. So Russia is trying to use this moment to establish some sort of broader security architecture in which it would have a role and Ukraine's security would form part of that security architecture. But that's very difficult to argue for when you're the one that's actually committing the invasion and committing the aggression, because Ukraine wants to be sure that it will be protected in future just against Russian aggression. So it's all part of a rather complicated chess game between the Kremlin and the White House and NATO on one side, with Ukraine in the middle.
And Tony, are we any closer to this much touted meeting between Putin and Zelensky?
Well, Zelensky said yesterday he's willing to meet Putin, though he won't see him in Moscow, and cast doubt on places like Budapest. He said it should be in neutral Europe. Putin's given no sign yet that he's ready to meet Zelensky. He's always said that he will do, but they have to have an agreement on the table, and they're very far from that right now.
OK, Tony Halpin, who leads our Russia economy and government coverage. Tony, thank you for that update. To Israel now, which is reported to have approved new settlements in the occupied West Bank, while its troops have now reached the outskirts of Gaza City. The Israeli military called up around 60,000 more reserve soldiers to join the war against Hamas, a sign that preparations are underway for a stepped-up offensive, despite ongoing talks about a ceasefire. And in technology, Microsoft is limiting Chinese companies' access to early warnings about flaws in its technology. The company has been investigating whether a leak led to vulnerabilities in its SharePoint software being exploited. Microsoft has blamed state-sponsored actors in China for a series of SharePoint hacks that affected hundreds of government agencies. And it's another busy week of earnings stateside with retail stocks in the spotlight. We got a disappointing sales outlook from Target yesterday. Today, up front and centre is Walmart. Up on deck, of course, the biggest retailer, at least the biggest grocer in the US. For more, let's bring in Bloomberg's Jennifer Creary for what to expect and what the earnings so far has told us about the health of the consumer and what's happening in terms of the retail space in the US. What are we learning so far about this sector, and whether or not there is resilience amongst the US consumer, where we're starting to get question marks about the labour market and maybe a little bit of softening?
Yeah, from these retail earnings, we're really seeing some of the holes in some of these retailers' business models. I think if we were to take one message from the US retail earnings so far, it's that it's a good time to be a discount retailer. Customers are really shopping around for value. So some of the winners so far, TJ Maxx, for example, raising their full-year earnings per share guidance, and that's thanks to its value proposition. On the negative side, there's Target. You know, big news coming out yesterday that it's replacing its CEO as it's really trying to turbocharge its turnaround. And, you know, it's having some difficulty with tariff-induced kind of price rises, and it's going to have to weather those storms. Now, looking ahead to Walmart, it's seen as slightly more resilient. It's probably able to weather some of those storms a bit better than its rivals. So analysts have a pretty positive read on the retailer so far. OK, maybe a bit more resilience amongst the Walmart numbers that we will get later today. You touched on tariffs. What is our broader understanding of the tariff impact? There was a reluctance after April for companies to pass on higher prices. Maybe there was a political play there. We were concerned about being targeted by President Trump. Is that starting to change? Are prices going up? Are tariffs starting to have an impact? Yeah, I mean, all retailers are very cautious to say much about tariffs at the moment. Of course, they don't want to spook investors. But we can point to a few so far. So Estee Lauder, for example, highlighting a $100 million hit to profitability from tariffs. We're seeing some retailers already raise prices. Walmart in Q1, for example, raising some prices on certain products, including baby products. Target as well in their earnings saying that they'll have to negotiate lower prices with suppliers. So they're really having to try and manage those costs before passing them on to the consumer. So we're seeing different ways. So TJ Maxx, for example, as well. They're an interesting case because they're a bit more shielded. Their business model means that they buy kind of excess excess inventory from other businesses. And so a lot of those fees are already covered by those businesses. So we're really seeing the differences in how retailers are shouldering some of those costs now.
Jennifer, excellent. Thank you very much indeed. Really great setup in terms of what to think about with the Walmart earnings up front and what we've learned already from the likes of Target. Jennifer Creary with that update and preview. Thank you. Meanwhile, to the auto sector, Ford is looking to develop a supercar for off-road racing as a follow-up to its new $325,000 Mustang GTD sports car. The CEO, Jim Farley, says he sees the vehicle as a dirt-loving, high-performance machine that could compete in the Dakar Rally.
I'm very interested in that. The off-road, the on-road performance hierarchy is very simple to see. And the very top is overserved, in my opinion. But no one's ever done this off-road supercar.
And after a months-long hiring spree, Meta says it has paused some hiring while it does, quote, planning and forecasting. The move comes as part of its latest restructuring of its artificial intelligence division, which will now be split into 4 distinct teams to better capitalise on new talent. And OpenAI says it could eventually offer a service whereby it helps other businesses to tap into the data centres and physical infrastructure needed for AI. The service could help offset some of the company's immense costs and would be loosely based on the success Amazon had in renting out its spare cloud computing capacity. Success, of course, Amazon continues to see. Let's check in on the markets then as we lead up, of course, to really the market-moving set piece of the week, which is Jackson Hole and Jay Powell's speech, of course, tomorrow on Friday. European stocks across the benchmark a little softer by 0.1%. The DAX over in Germany dropping 5 points. Over in France, slightly heavier selling, down 0.3% on the CAC 40. And the FTSE 100 after a 24th record close yesterday, year-to-date. Further upside in the session today for UK stocks, up just 0.1%. US futures, let's check in after there was a bit of dip buying for some of the tech names yesterday. S&P futures flat, Nasdaq 100 futures pointing higher by 0.1%. Coming up, we'll focus on the UK and Chancellor Rachel Reeves. Stay with us. This is Bloomberg. Good morning, welcome to the Pulse. I'm Tom Mackenzie in for Francine Lacqua in London. These are your top stories. Happy Thursday. Fed Governor Lisa Cook says she will not be bullied into stepping down after President Trump demanded her resignation over allegations of mortgage fraud. Tech stocks stabilise after a 2-day sell-off as markets tread cautiously ahead of Jerome Powell's Jackson Hole speech tomorrow. Plus, the US says Russia wants Ukrainian territory it does not yet control as Moscow pushes for a role in the security plan for Ukraine. Let's check in on gilts right now as we look as well, crossing the terminal right now, the red head on terms of the data around services and composite PMI out of the UK. August services PMI rising to 53.6. That's a pretty strong number. The forecasts have been for 51.8. So the services PMI data convincingly in expansionary territory. Composite PMI for the UK coming in at 53. The forecast had been for 51.6. This, of course, on the back of the latest GDP data that we got a couple of weeks ago that suggested slightly more strength in the UK economy than some had expected. The gilt markets then, currently you're seeing yields up 2 basis points across the curve. The front end, the 2-year is yielding 3.94. The 10-year at 4.69. So very modest selling pressure. You're seeing that reflected, by the way, in the sovereign debt of France and Germany as well on the back of slightly better PMI data there. So it's not just the UK where you're seeing a bit of selling when it comes to sovereign debt, but you're seeing yields up around 2 basis points with the front end at 3.94. Now, the UK Chancellor will be heading into the autumn once again on the fiscal ropes. We've said that before, haven't we? Bloomberg understands Rachel Reeves is weighing a tax on high-value family homes at the point of sale to plug a £10 billion budget hole. That's just for 1 year. Bloomberg's John Stepek joins me now in terms of what we should be thinking about. So, John, you follow this very closely. What kind of taxes, what kind of changes should we be braced for then?
Well, I think this is interesting because this is classic August news stories. There's a lot of kite flying going on at the moment, which is worrying for other reasons. But on Monday, we got a report that the Chancellor was looking at reforming stamp duty and council tax. and replacing them with a kind of annual property tax that would basically be like a seller's tax. In some ways, that's actually a good idea, but it's extremely complicated and quite easy to mess up. And it appears the Treasury sort of pushed back against that. And then on Tuesday, we were hearing that actually what they were looking at was, at the moment, if you own a home and you live in it, then you get an exemption when you sell it from capital gains tax. And what they were looking at was scrapping that exemption on people with houses worth more than 1.5 million. So when you sell your 1.5 million or plus house, you'd be liable to capital gains tax on that. Now, it sounds like an easy way to raise money, and you can also turn it as a mansion tax, as a tax on the rich. You know, you're not kind of talking about inflicting pain on working people, but it's actually it's rife with potential for disaster. Because the first thing that will happen if capital gains tax is imposed on houses of this value is that the Tories in Reform will turn around and say, come 2029, we're scrapping this. So no one will sell their house because, you know, why would you? Whenever you can avoid the capital gains on it simply by waiting. So I don't think any of these proposals will fly. And if they do, I don't think they'll raise the kind of money that they hope they will.
So what are the other options, John? What are the other options? What else? What are the other levers that this Chancellor could reach for? She's going to have to do something.
Oh, she has to do something. But this is the problem. She's kind of ruled out all of the things that would actually move the needle easily. I mean, this is the real problem. The real problem with this is that she's ruled out raising income tax, national insurance, VAT and corporation tax. And between them, they account for basically 75% of the UK's tax take. So that leaves you with 25% of somewhat more random taxes and tax reliefs. But if you mess about with any of those, then everyone's financial planning is completely messed up. So we already had messing about with inheritance tax at the last budget. We have constant rumours, and we have done for decades actually, that pension relief is going to be changed in some way. But as soon as you pull, it's a bit like the kind of reforming property tax issue. As soon as you pull on any of the threads of that, it suddenly becomes incredibly complicated. And at best, you could launch maybe a review or a report at the budget into how you're going to do this properly. And I mean, that might be a good idea. I mean, certainly, stamp duty is a terrible tax. It should be replaced. It could make the property market much more efficient if they get rid of it. But doing what they're thinking about doing just now would just be a disaster. It would grind the market to a halt. And it's already not doing brilliantly.
Yeah.
There's lots of things she can look at, but I think the problem is because she's boxed herself in. In an ideal world, she would just reverse the national insurance cuts that the Tories made at the end of their term. Which were kind of clearly a bear trap for Labour to fall into. Well, unfortunately, that is exactly, they have fallen into it. The other option is she could look at the fiscal rule. The fiscal rule is kind of made up. As long as you have a good story to tell markets about why you've decided it's no longer tenable, then I don't think the gilts market would throw a wobbly.
That's what the left-wing members of the Labour Party are pushing for, isn't it?
Yeah, the problem is you've got to tell a good story, and they wouldn't. It's like you've got to kind of got to make people understand that we aren't throwing this aside because we don't want to meet it. We're throwing it aside because it's too restrictive at the moment, and we're going to make considered reforms that are going to promote growth while cutting the debt. But yeah, you're right. If they actually just said, no, we're not doing it, and then just kind of decide to spend a load of money and putting up doctors' salaries or something like that, the gilts market would be less keen on that.
Okay. John Stepek, fantastic. Thank you very much indeed on the tightrope, of course, that this Chancellor has to walk, and the unenviable options as well. John Stepek is, of course, the author of Bloomberg's Money Distilled newsletter. You can get it on Bloomberg.com and, of course, on the terminal. Do read that. Now, the UK government, staying with the UK, is preparing to take control of tycoon Sanjeev Gupta's steelworks should they fall into liquidation. Lawyers for a creditor to Speciality Steel UK, part of the Liberty Steel Group, told a London court that government officials were preparing to appoint special managers in the event that the steel operations are wound up. It would be the second time that the government has intervened in the steel industry after it took over the British steel plant in Scunthorpe earlier this year. Does loyalty pay? If you ask a member of Gen Z, the answer is probably not. According to a new survey conducted by Intuit Credit Karma for Bloomberg, many young people have multiple current accounts to manage their money these days. Wait, did we need a survey for that? Let's get more from Bloomberg's senior digital finance editor, Ana Herrera. I'm being flippant, of course, but I could do an unscientific poll of younger friends of mine, and they all have 3, 4, 5 different bank accounts. Why is this, Anna, why is this potentially a problem, particularly for the incumbent banks?
So banks spend so much money in acquiring customers, and even more now that you have so much choice, right? But traditionally, you make more money from customers when they age and when you're able to sell them more profitable services like loans, right? So if they're not sticking around, they never get to the threshold where they're making you money. And that's becoming more of a concern with Gen Z because we spoke to someone who'd made £2,800 just opening bank accounts from like incentives, and he had over a dozen accounts.
£2,800 just by opening bank accounts.
Yeah, and he had a dozen bank accounts, right? And he was saying loyalty doesn't pay off, and he has a TikTok account where he's teaching other Gen Zers how to make money from incentives. So it is starting to become a little bit of a challenge for both fintech banks and also the bigger banks.
So how is the industry responding?
They are launching more incentives, which I guess, and also ones where they pay you if you stick around. So an annual incentive if you're staying for a year, for example.
You get paid for being a customer. Because still in the US, sometimes when you open an account, you have to pay for that account. But here in the UK now, you're getting paid.
Yeah, exactly. Or if you're referring friends, because we saw Gen Z actually is more inclined to join a bank if they have a friend referral. And some others are just leaning in. They're saying, you know what, we can't get them to stick around on one app. Let's open multiple apps because they like ease of use. And so we'll just lean into it. Or we'll let them stay in our ecosystem, but, get services from other people.
What are some of the craziest promotions that you've come across?
Yeah, we spoke to Nationwide, and they took over a fried chicken shop in Shoreditch last year, and they got in influencers, and they were paying food delivery bonuses. So they gave around £200, I think it was, to spend on food delivery.
Yeah, so when I asked about crazy, I did not expect your answer to involve Nationwide. I don't usually associate Nationwide with crazy and chicken shops in Shoreditch, but there you go. This is what's happening as they try to respond. Ana Herrera, thank you very much indeed. That reporting, of course, on the terminal and on Bloomberg.com. Bloomberg's senior digital finance editor on the lack of loyalty amongst Gen Z. Ana Herrera, thank you. Now, we are going to switch focus, talking about wealth, but of a slightly different scale, because Africa's richest person, Aliko Dangote, has built a $20 billion oil refinery in Nigeria, bigger than any in Europe. But critics are questioning whether his dominance will truly benefit the nation or mainly just enrich himself as he seeks to ban foreign competition. Joining us now for more on Bloomberg's Big Take is Jennifer Dabasaja, who's across this story for us. Jen, who is Dangote? How did he become so wealthy, and why is this refinery so important to Dangote and potentially Nigeria itself?
Right, Tom. Dangote, for many people, stirs a bunch of different emotions. But if you take a look at what he's actually been doing over the past few decades, he made his first billions in his cement business. But his family has been in the commodity space for a number of years. He's traded things like cocoa and other cocoa, cotton, cashew nuts, and even sesame seeds. But really, the focus over the past few years has been on this oil refinery that you were just speaking about. And the reason is a bit twofold. If you take a look at Nigeria, it is Africa's biggest oil producer. It's also the most populous OPEC nation. And yet it has spent the bulk of the past few years and decades having to export crude to Europe and other places and then import it back as a refined product. That has cost the government billions of dollars. Not just that, it's also been a drag on the economy because of the subsidies and also corruption. And so the fact that now there is this refinery in the country has been very significant for this administration. And of course, Dangote, you mentioned it's $20 billion. It took him nearly 11 years to actually get this up and running. And as our Bloomberg Big Take really digs into, this is for the first time in 3 decades, we're going to be seeing Nigeria being able to export refined products in a way that they haven't been able to do before. So many people, as you were just mentioning there, critics are wondering, though, whether or not this is going to be a lasting change for this economy and whether or not oil sales are really going to be a boost for the Nigerian economy, or whether or not it's just going to keep making Dangote even more wealthy than he actually is. And just to give you a bit of stats, in the past 3 months, his wealth has gone up $1 billion to $28 billion. And so this is, of course, adding to the empire he already had, but still affecting one of the most populous OPEC producer.
Yeah, of course. I mean, certainly, and the changes are there, and he's made this commitment, this investment. What is next then? What is next? The next step? What is the future looking like for Dangote himself?
There's still a lot that this refinery needs to do in order to get the maximum capacity that Dangote sees and even that local producers are hoping to see. And so there's still quite a bit that we're waiting for in terms of this refinery. For Dangote himself, we did recently hear that, I was mentioning earlier, that the first bit of his billions in wealth did come from his cement business. He recently announced that he was going to be retiring from the chairmanship role. And instead, they're appointing a former executive of EcoBank to be the chair of Dangote Cement. But Dangote's empire, as I was mentioning, doesn't just stop there. He's been in the commodity business for his whole entire life. He now sees fertilizers potentially being the next boon for the Nigerian economy. He also is looking at a deep seaport for Nigeria. And so this is not the last of Dangote, this refinery. And as he says to us, he wants Africa to be industrialized and be able to produce and export their goods and get the value add that many leaders talk about day in, day out.
OK, well, that ambition is still there, isn't it, for Dangote? Jennifer Zabasaja in Johannesburg, Thank you. You can catch more, of course, of Jen in the next edition of Next Africa. That is on Friday. Coming up to the earnings story, and this time, shares of Novonesis slumping, one of the biggest losers in the session so far. That's after the company trims its revenue forecast, margins not as punchy in terms of the outlook as some had hoped for. I'll be speaking to the CEO next. This is Bloomberg. Oaktree Capital's co-chairman Howard Marks is warning US stocks appear to be in the early days of a bubble. Marks spoke exclusively with us about his concerns over rising valuations and investor complacency.
This is all just feeling and an opinion. None of this is factual, but it does seem that stocks are expensive relative to what I call fundamentals, or you might call reality. And, the outstanding reason, I think, is that, there hasn't been a serious market correction in 16 years. So people get out of the habit of thinking about market corrections. The biggest single mistake, I've been thinking a lot, what is the biggest single mistake investors make? And I've concluded that it is that they conclude that the way things are today is the way it'll always be, and the things that have been happening will always continue to happen, whereas reversion to the mean is much more likely. So I just think that it's worked very well. Being an equity investor has worked very well. Doing it on leverage has worked even better. Concentrating in a few stocks has gone very well. Investors are by nature optimistic, and that optimism dies hard. I just think that the fluctuations of the market are mostly related to psychological fluctuations, and people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much. And that's the continuation that creates bubbles. And, we're probably in the early days of that.
When you talk about liking, Howard, maybe liking these assets a little bit too much, can you put into perspective the last time you saw this type of environment that left you thinking maybe some of the opportunities aren't as great when it comes to buying some of these assets at current valuations? Is there another time that this sort of reminds you of in any capacity?
Well, I guess, Lisa, the last time was probably around 97, when the market was kind of falling in love with tech stocks. And, the market was rocketing along. People were not worried about the level of valuations. People were extremely optimistic about the opportunities for the internet. Alan Greenspan famously cautioned that there might be irrational exuberance. Now I picked 97 because even though Greenspan was concerned about exuberance, the market went on to rise for another 2.5 to 3 years. Remember I said we're in the early days.
Oaktree Capital co-chairman Howard Marks speaking exclusively to Bloomberg. Back to the news story now. Novonesis shares slumping today. The biosolutions company that produces enzymes, proteins and pharmaceutical ingredients reported earnings earlier. Analysts say a profitability miss and merely reiterated margin guidance disappointed. Joining me now to discuss the news behind the numbers is Ester Baiget, CEO of Novonesis. Esther, thank you for joining us this morning. The stock is now down 6.6%. It seems to be margins and the forecast around margins is where some of this disappointment lies. You're projecting margins for the longer term by 2030 of 39%. Some of the markets expected 40% or more. Why couldn't you meet those expectations?
Thank you very much for inviting us today. We're very pleased with the results we delivered in the first half with 9% revenue growth and profitable revenue growth. Also maintaining the EBITDA guidance for the year, including the headwinds we're seeing from currency. So upgrading the revenue growth for the year and then maintaining the EBITDA margin for the year guidance, including the strong headwinds we're seeing from currency. To your second part of the question on the guidance for the long term, we are a growth company, and that's exactly what we're committing to, profitable growth. 6 to 9% growth while expanding profitability from a very strong base from 37 to 38 EBITDA margin. We feel very pleased of where we are. We feel very comfortable of the strong foundation in place, and we're going to continue to build on a success formula of growth. Be close to our customers, be there with innovation, continue to invest with resources to be the partner of growth for our customers and deliver on this beautiful 6 to 9% profitable growth, a 6 to 9% that we're committing to.
Okay, that beautiful 6 to 9% by 2030. Esther, how would you characterize that? How would you frame that? Is that a conservative outlook?
I think it's quite a strong outlook, 6 to 9% at 39% EBITDA margin at the end. 6 to 9% CAGR through the period, and at the end of the strategic period, 39% EBITDA margin. We're talking here about bringing solutions that transform the way that we produce and the goods that we consume. We're talking here about solutions that enable high protein content without compromising taste, texture, palatability, nor cost. We're talking solutions that enable cleaner label. We're talking solutions that allow high efficiencies, higher yields, less microplastics, new building blocks on how the fuels that we use and the energy that we consume. Those are the categories that we're in, and those are the categories that we continue to invest to deliver on that 6 to 9% and also margin expansion through the strategic period.
At a time, of course, where we have tariffs and we have 15% on the Eurozone agreed in that deal with the US. What is the tariff, Esther, what is the tariff impact on the business now and into the future?
That's an amazing question, because that implying that you know what is going to be the tariff situation in the future. So I'm going to base and frame my answer on today. We do live in the same world that you do. We forecast a neutral net no impact of tariffs for 2025. We are exposed to tariff marginally. Most of what we produce, what we sell in US, it's produced in US. And then the areas that we're not, we will bring mitigation efforts through optimizing extremely global and resilient footprint, while also through pricing through our customers. Through net impact from tariffs on 2025, it's margin, it's none. It's neutral and none. Then it is true that this could cause impact on the consumer behavior. And that's the reality that we live. We see some slowdown in household care. We see also some softness in beverages, but at the same time, we continue to see extraordinary pull on the growing demand for solutions for cleaner labor, higher yields, higher efficiency, muscle weight, advanced protein solutions that complement the way that we eat and to bring solutions to the consumers.
And you updated your strategy today, Esther. To what extent will M&A play a role in that strategy?
The 6 to 9%, it's organic growth. So we're committing to what we are going to deliver on what we have today by continuing to invest on whom we are and by continuing to be closer to the customers. We are a biosolutions powerhouse. We bring biological-based solutions to respond to our customer needs of today and the future. And always we are going to be explorer and open to options in the market that could build up and expand and boost our performance and drive a value-added accretion for our shareholders while making us also even a stronger partner of growth for our customers.
OK, you describe yourselves as that powerhouse. Some of your competitors have come out as well. They've given their guidance. Esther, do you think if we take a step back, do you think growth for the industry is normalising?
Yeah, I mean, we bear in mind that we play in the same markets that they grow 1 to 2%, and we're putting a guidance to 6 to 9%. So we are always outgrowing the markets that we present, and we're being that by doing that by being closer to the customers and by bringing them more portion of the answers of the future that they grow faster. You cannot make low sugar added with cheaper sugar. You cannot make low salt with also more competitive sugar. You cannot make no microplastics with cheaper microplastics. So this is why we're growing faster of the markets that we play in. We see a little bit of a slowdown, as I mentioned, in household care, particularly in North America. We're watching that very closely, but that's also embedded within the guidance and also on what we see for the strategic period and how we're seeing the normalized growth of household care moving forward.
Ester, Baiget, CEO of Novonesis, on the back of those earnings and those results and those targets into 2030, of course, 6 to 9% in terms of organic sales growth. Ester, thank you very much indeed for your time. Let's stay on the corporate news story in a redhead crossing right now. We've been talking about deal making there. This time it's deal making in terms of the finance space. Mediobanca investors rejecting Banca Generali's bids in a blow to the CEO. Mediobanca investors rejecting Banca Generali's bids. They're saying that the offer on Banca Generali has lapsed. That is according to Mediobanca. This is a story we'll keep across for you, the pricing reaction to that and more details.